If Forex has ever felt confusing, you are in the right place. Welcome to Nesh, where we break it down and make it simple. Welcome back to where we are simplifying Babypips course, and today we are looking at buying and selling currency pairs. So let's get started. Alright, so what is Forex trading? Forex trading is simply the buying of one currency and selling of another at the same time. This is because currencies are always traded in pairs like Euro USD or GBP JPY. So whenever you place a trade, you are buying one currency while selling the other. You can think of it like a tug of war, where each currency is competing to become stronger. The exchange rate then shows the value of one currency compared to the other, depending on which one is stronger. Now, currency pairs are grouped into three types, and these are majors, crosses, and exotics. Majors always include the US dollar, crosses don't include the US dollar, and exotics involve a major currency and a smaller or emerging economy. In simple terms, Forex trading is all about trading currency pairs and predicting which currency will be stronger. Alright, now let's talk about major currency pairs. These are the most traded currency pairs in the Forex market, and they all include US dollar on one side. Some common examples are Euro USD, GBP USD, and USD JPY. Now, the reason these pairs are so popular is because they have high liquidity. Liquidity simply means how active the market is or how easy it is to buy and sell a currency pair. So the more people trading a pair, the higher its liquidity. For example, Euro USD is traded more than most pairs, which makes it one of the most liquid. And in simpler terms, major pairs are the most popular and easiest currency pairs to trade. Now let's talk about cross currency pairs, also known as minor pairs. And these are currency pairs that do not include the US dollar. So instead of trading against the dollar, major currencies are traded directly against each other. For example, pairs like Euro JPY, GBP JPY, or Euro GBP. And even though these pairs are not as heavily traded as the majors, they are still quite liquid and offer plenty of trading opportunities. So cross pairs are just major currencies being traded against each other without the US dollar. And now looking at Euro crosses, these are simply currency pairs where the euro is traded against other currencies without the US dollar. So instead of trading Euro USD, you're trading pairs like Euro GBP, Euro AUD, or Euro Swiss franc. And simply, Euro crosses are just cross-currency pairs that involve the euro. The next one is yen crosses. These are currency pairs where the Japanese yen is traded against other currencies without the use of dollar. So instead of USD JPY, you'll see pairs like Euro JPY, GBP JPY, and AUD JPY. And in simple terms, yen crosses are just cross-currency pairs that involve the Japanese yen. So let's look at pound crosses, and as we have discussed on the previous one, these are the currency pairs where the British pound is traded against other currencies without the US dollar. And so instead of GBP USD, you'll see pairs like GBP Swiss franc, GBP Australian dollar, and GBP Canadian dollar. And pound crosses are just cross currency pairs that involve the British pound. I hope you're getting this right. So now looking at the other currency pairs, we have pairs that don't include the US dollar and also don't involve the euro, the yen, or British pound. So they are basically smaller combinations of other major currencies like Australian dollar and New Zealand dollar, AUD card, or New Zealand dollar and Swiss franc. And in simple terms, we can say that these are just less common cross pairs that traders can still trade. Okay, now let's talk about the exotic currency pairs, and these are pairs that include one major currency and one currency from a smaller or emerging economy. For example, pairs like USD and Mexican peso, or this other one here. Now, unlike major and cross pairs, exotic pairs are not traded as much, which means they have lower liquidity. Because of this, they usually have higher trading costs and can be more volatile. So exotic pairs are less common, more expensive to trade, and can move more unpredictably. So if you're trading this, you gotta be careful. Let's talk about G10 currencies. These are the 10 most traded and most liquid currencies in the world. Because they are traded so frequently, they are very easy to buy and sell, and individual traders don't have much impact on their prices. This group include major currencies like the US dollar, the euro, the British pound, and Japanese yen, along with others like the Norwegian krone and Swedish krona. So G10 currencies are just the most important and the most actively traded currencies in the Forex market. Moving forward, let's talk about the Scandies. This term refers to currencies from Scandinavian countries, specifically Denmark, Sweden, and Norway. Their currencies are the Danish krone, Swedish krona, and the Norwegian krone. You'll notice they have similar names because the word krone or krona actually means crown. So Scandies are just the currencies from these three Scandinavian countries. Alright, let's move forward very quickly. Let's talk about CEE currencies. CEE stands for Central and Eastern Europe. Alright, these are currencies from countries in that region such as Poland, Hungary, the Czech Republic, and Romania. Their currencies include the Polish zloty, Hungarian forint, Czech koruna, and Romanian leu. So CEE currencies, or the Central and Eastern Europe currencies, are just currencies from Central and Eastern Europe countries that are sometimes traded in Forex. All this information is giving you the general information about these currencies, so you don't have to worry about them. We have something else that we call BRICS, and BRICS is a group of major emerging economies. including Brazil, Russia, India, Indonesia, China, and South Africa. Their currencies include the Brazilian real, Russian ruble, Indian rupee, Indonesian rupiah, Chinese yuan, and South African rand. And we can say that these countries are known for their economic growth, which makes their currencies important in the forex market. So in simple terms, BRICS refer to large, fast-growing economies and their currencies. Alright, now let's talk about BRICS Plus. This is basically an expanded version of the original BRICS group, which included Brazil, Russia, India, China, and South Africa. And over time, more countries have been added, such as Saudi Arabia, the UAE, the Egypt, and others, making the group even larger. And because of this expansion, BRICS Plus now represent a significant portion of the global economy and population. So finalizing about BRICS Plus, you can say that is a growing group of major emerging economies that are becoming more influential in the world. Alright, let's quickly summarize everything we have covered. So in Forex, we trade currency pairs, which means the value of one currency is compared to another. And the most important pairs are the major pairs, which all include the US dollar and are the most frequently traded and also most liquid. Then we have cross pairs, which don't include the US dollar but still widely traded. And we can say that even though there are hundreds of possible currency pairs, you don't need to trade all of them. In fact, most traders focus mainly on major pairs because they are more stable and easier to trade. And lastly, I can say that just focus on the main pairs, understand how they move, don't overcomplicate things, and then that's all you really need to get started in Forex. Yes, that one was good. And now after we are done with this chapter, we'll continue tracking our progress. So we will click here and you press to the next lesson. And now in this next video, we are going to talk about the Forex market size and liquidity. Alright, you are officially getting smarter in Forex and follow Nesh trades or trade with Nesh, and let's keep learning together. So subscribe and share with your friends, and see you in the next one.